Good afternoon, good evening, and whatever part of the world you are joining in from at this point. So what we are going to be talking about today is how blockchain is disrupting the finance industry. And Murthy obviously gave a little bit of brief about me, so thanks for that. Let me quickly add a few bits to that. One is I'm the co-founder and CEO of two companies. One is Primafelicitas, the other is Barter Trade, and Barter Trade is a centralized exchange. I'm going to talk about that a little bit. Primafelicitas as a company is primarily into core blockchain development, and we work closely with governments, enterprises, and startups. Whereas Barter Trade is more of a leading exchange where you could trade into cryptos and crypto to fiat and few other functional properties. The company is located in three different areas: San Francisco, London, and Delhi. Delhi is a tech center. And Barter Trade obviously is in four continents: Europe, Asia, and in the Middle East. In terms of personal expertise, I have mostly on the side of blockchain technical and business consulting. I sit on the board of several blockchain companies where we've been doing work for the past several years. And overall 18 years of experience, primarily in strategy, marketing, led global organizations. Education-wise, IIT undergrad, and then master's in business from Stanford. So that's in a nutshell what I sort of been doing. Now, in terms of the agenda for the day, we're going to be talking about three things here. One is the context. So the context in which this entire presentation is placed. To what is the overview of blockchain and how that piece applies to the financial industry and how it is taking the financial industry forward. And then obviously the innovation of the financial sector per se. So in terms of the context, there are a couple of things which are very interesting to be noted here. One is the projected value of the blockchain industry is going to be close to $175 billion by the end of 2025. That's how the projection. I mean, you can look at different reports. The numbers are going to be here and there a little bit, but mostly in that ballpark. Compare that with the artificial intelligence market, which is obviously several decades old. Year 2025, it is supposed to be $150 billion. So a technology which has been there roughly for 5 or 6 years, right? Truly, if you look at blockchain, when it started to find good use in the business and other areas, was in the year 2015, right? So technically in 5 years' time, a technology is competing with artificial intelligence, which has been there for several decades, obviously maturing to various degrees. Why is this the case? The reason is blockchain finds its use in almost every industry, every walk of life you can think of. We talked about governments. There's obviously the voting application where obviously governments are extensively trying to see if they can use blockchain. Healthcare, automotive, real estate, shipping, logistics. You name it, and there's definitely somebody who has a product which is running in that industry. And that is the reason why this industry is flourishing. Now, let's move to another context. And in this case, I want to tell a story and then draw an analogy based on that story and see how that applies to our case, especially about the financial industry. So context-wise, the year 2003, if you look at the global music records industry's revenue, that revenue was $20 billion. Fast forward 15 years, the same revenue has shrunk by $1 billion. Now it is close to $19 billion. However, another interesting thing has happened in the interim. This revenue of 19 billion is actually shared now between two kind of service providers or two kind of businesses which are providing access to the music. And what is this other kind of access? The first obviously is the traditional brick and mortar where you have to just go to the store, pay and get your music, or you have to get it shipped. So there's a physical version of that getting shipped to you or you going there. The other is a newer version, which is the streaming services. So streaming services came in and last 15 years took almost 50% of the revenue from the traditional industry, right? So the music industry, in a sense, sort of got disrupted. And let's see who are the players actually were doing this. So the players were Apple, YouTube, Spotify, Amazon Music. Collectively, these four companies control almost 80% of the streaming business, right? The rest 20% is various exotic businesses. Now, one interesting thing which we can look from this or draw from this particular, graphs is 2003, these companies weren't even in the music business, right? So these are primarily internet companies which have got, traditionally nothing to do with music. They came in the music industry and basically took a deep chunk out of that, right? And the pace at which it is growing, it's growing roughly at 34% year on year. In the next decade or so, I believe they'll be close to 90%, if not 100%, right? So if they are able to take that big piece of the business, what exactly was it that caused it, right? The number of ways which you can look at, of course, that the internet era was there and these companies came about. They spotted an opportunity in the music industry and they built a business model which obviously is defensible, and that's how they took the share away. But if you look at it more deeply, I think you're oversimplifying this problem and overlooking number of key issues. So 2003, the way you could get your music was going to a physical store or getting it shipped, right? So to get access, there was a physical element, right? And what these internet companies did, or these streaming companies did, was look at this access problem and solve this problem, right? And so streaming provided that access to a lot of people who may not have the ability or the time to visit the stores or get it, right? So because of that fundamental reason, these companies were able to disrupt, right? So there was an access issue which these companies solved. Now let's look at the financial industry, and we talked about this particular context and said how that context is going to apply to the finance industry. So finance industry also has an access issue. What is that access issue? If you have to use any of the financial industry products, more or less you're looking at getting an appointment to the institution, going there, doing yourself, KYC, submitting all your documents, getting yourself approved before you get access to the ecosystem, right? And it could take anywhere between 1 to 2 weeks, right, depending on your credit history and the rest of it, right? So that's number one friction point. The other friction point is, of course, if you are, let's say, unemployed, or if you are a student, or if you are an immigrant, right? So some of these categories, and again, I'm picking on these categories. There are so many other categories which are similarly treated by the banking and financial institutions. So these categories of customers are not really of interest to the bank so much, and the reason is they don't have the traditional background which the banks want in their users or customers, against which they can sort of verify, do KYC and the rest of it. If they don't fit in the the framework, they are not really interested in getting you as a customer. So those two friction points actually make the current financial system not very suitable or adequate, at least to the current millennials, right? And what's happening is a number of things, which is where financial institutions play, right? So before we even get there, I think one of the fundamental things that needs to be addressed is, why do finance industry or the financial institutions as we know them today even exist, right? What is the purpose? What are they trying to do, right? So fundamentally, what they're trying to do is address the counterparty risk involved in any transaction. You take an example of two different parties on two different continents trying to do a business deal. How do you bring in that trust? There's always that risk. So imagine somebody in a small city in Nebraska trying to do a trade with somebody sitting in Delhi, right? How do you trust the person that the goods are going to be shipped and he's going to pay on time, or if the person is already paid, whether he's going to get the goods? So that kind of risk in any deal is what the banking and the financial institutions set out to address. And how they do it? They basically do it by providing the trust. And what is this trust? The trust in the case of the financial institutions is fairly straightforward, that you're giving them the money is going to be successfully given to the recipient on the other end, right? And if there's any issue with the transaction is reversed, and obviously you get the money. So as long as you've done all the right things, provided your PIN, you've signed it correctly, done the correct wire transfers, the money is going to get on the other side. So that is the trust which the banks provide. And how do they do it? They take on the risk, right? That the other person is going to pay, is going to honor the contractual obligation of entering into a specific deal. So that's one reason of their existence. And how they actually execute is a very interesting story, right? So imagine this particular bank in Nebraska. Imagine it's a very small credit union bank, and they're trying to transact with a bank here in India. Um the best way, of course, is that this particular credit union also has a branch here in Delhi. And so it's a very straightforward internal funds transfer. But given that this is a very small credit union bank, and there are so many outward remittances to all parts of the world, if they start opening branches everywhere, it's very quickly going to be unfeasible to actually run the business, right? And so what they have to do is they have to rely on what is called as a trusted network of financial institutions, right? These, of course, comprises banks, but also trading houses, clearing houses, brokerages, custodial services, whole host of financial and banking institutions, right? And they come together as a consortia, right? And the consortia, most of you might have heard of the SWIFT Society. At least people who have used onward remittances in some form would know that there's a SWIFT code, and the SWIFT code is a nomenclature coming from the SWIFT Society's operations, right? And so everybody is part of this close network or consortia of banking financial institutions designated as SWIFT. And so what happens is banks can then use this particular network, here in India, and in the interim from the US if they're trying to transfer, using the SWIFT network's codes, right? So using that messaging platform, they are able to transfer that information overseas, saying this is a ledger transaction and this is between these two parties. Please transfer these many dollars, right? So very straightforward process coming out of the SWIFT. What happens though is, because all this information is under one single umbrella, there's obviously a risk of that information, data, and so many other aspects. And we are going to talk more about how centralization increases risk in any system. But at this point, we can take it that because it is centralized, there's a huge risk that comes along with it. And finally, because this particular bank in Nebraska is relying on a network, they have to pay the network, right? Because the network is enabling the transfer of value from one point to the other. Network obviously has to be paid for their services, right? And who pays the services? It's not the banks who pay the services. It's the customers, you and I, who pay the service, who pay for the services. And how do we pay? We pay in the form of wire transfer charges, right? Both for outward and also inward if it's a specific bank, right? So up to 35, 40, $50 you could be paying on a small transaction. If it's a small ticket transaction, 200, 250, $300, that's a lot of money, especially that kind of ticket sizes for remittance market where people are remitting money back home. And if you charge almost $50 on a $200, $250 transaction, it's a huge money. Whereas if that money is on $50,000, 100,000, that's a different story, right? So in essence, the finance industry again has similar issues of access, right? And the selection criteria that they have for having people as their clients. And all of that is dependent on a network of intermediaries to facilitate transaction, right? So it's not a straightforward transaction. There is a huge host of intermediaries who provide that trust. Now, with that, let's understand, first of all, what is blockchain, and then how blockchain will help or is helping finance industry actually move to the next level. So what is blockchain? At a very high level, we can think of blockchain as a ledger, nothing more than a ledger, to be very honest. And on this ledger, you can store transactions, and these transactions could be, people transferring money, video files, audio files. You can anything which can be in the form of a digital signature and hash can be stored on the blockchain or in this ledger, right? And this ledger can be viewed by anybody. So anybody who has access to internet can go and look at that ledger, which is obviously not the case if you are in any other industry. For instance, if you are in a very centralized business such as Google, Facebook, you obviously cannot look at the ledger. But in this case, you can look at the ledger, but you cannot add information. you can only add information if you're part of that network also. So to become a part of that network, obviously there's a process, and anybody can again become a part of that network also. But by and large, if you do not have the membership, you cannot add information. And of course, nobody can edit or modify information. And I'm going to tell you why that is not possible on blockchain. But because you cannot edit and modify, therefore it is immutable. All you can do is add more information. So more or less, it is like a giant interactive Google spreadsheet where people can go online and look what's happening or who's doing what transaction with whom. But they can only do something in terms of adding information if they have access. Otherwise, they cannot. And the information actually doesn't get stored as is, right? So as soon as a transaction happened, it's not that automatically it's going to get stored on the ledger. It has to first wait for a certain number of transactions to get approved by the network. So obviously each transaction that is submitted to the blockchain doesn't get stored automatically. It has to be approved first by the network, and then it is stored on the blockchain. And these transactions, as I was saying, don't get stored straight away as is they come. They are actually stored in batches or a number of transaction in a particular block or a batch, which is what is called as a block in the blockchain. So a fixed number of transaction in the block, and that's how a block gets approved and then gets stored on the blockchain. And the last bit is these blocks are linked to each other cryptographically. So the last block is linked to the second last block. So it's basically gets appended, right? Each new block gets appended to the last block in the chain. And you can sort of visualize this more or less as you might have seen in the Merkle trees or linked list, some of those arrangements where cryptographically you're pointing to the previous block. So that is how you get this name blockchain, because there are blocks and they're connected to each other. Now let's look at the blockchain from the perspective of storage. So how is information stored on the blockchain? But before we talk about how is information stored on blockchain, let's first understand how is information stored traditionally. So traditionally, think of this as maybe Google or Amazon. Let's consider Amazon here. So imagine this is the Amazon's database, right? And information is getting transmitted from all these different devices, mobile devices, laptop, desktop, and people are entering all sorts of information, billing information, shipping addresses, credit cards, user IDs. All of that information obviously is getting stored here, right, in this central data center, and you are getting a copy of the ledger, right? And this copy of the ledger is only under the control of Amazon. And you have the ability to make smaller changes, such as changes in the password, maybe the shipping address, bank account, the new card you want to attach. But any major things such as your KYC documents, your verification, all of that has to be approved by Amazon before it can get stored on the servers, right? And the architecture looks something like this. You have the central point, which is very, very secure, both digital security and physical security. And you have all these different nodes contributing information. So this is a single point where everything is, stored. Of course, this, information here is also distributed. So they don't always keep the entire information in one location. There are multiple locations, but it's not, let's say, spread globally across millions of devices, which is what blockchain is. I'm going to talk about that now. So in case of blockchain, each node here has its own copy of the ledger, right? And this is the same copy of the ledger. Here you see it's only Amazon which has the copy of the ledger and they control the copy. Here everybody has the same copy of the ledger. And as soon as any transaction happen, imagine this device is conducting a transaction. So not only this ledger gets updated, but this information is propagated throughout the network and the entire network's database gets updated. So everybody again has the same version of truth. As I was saying, it's only one version of truth here. Here, everybody has the same version of truth. Now, this is how the network looks like, right? all of these nodes have the same copy of the ledger, and they are distributed globally. And here you only see 6-7 devices, but these are primarily millions, tens of millions of devices spread globally. Uh, Here, I think one interesting thing which is worth noting is that the central system is also a central point of failure, right? All a hacker has to do, one of the shrewdest hackers has to get into the system, bring this thing down, and as soon as you are able to bring the central system down, the entire network collapses, right? And it might sound a little out of the world, but all the major hacks, Social Security, Marriott, you name it, have been executed fundamentally in this particular fashion, where the hacker has managed to gain access to the central systems and bring the entire network down. Now, if you have to do the same in the blockchain network, which is obviously everybody has the same copy of the ledger, and these copies are distributed across tens and millions of devices globally. So the only way somebody can do it is by executing a 51% attack. So what is a 51% attack? A 51% attack is primarily an attack which is able to compromise 51% of the network's nodes, right? So imagine there are 10 million devices, and you have to simultaneously hack 5 million devices, right? So if you are able to do that at the same time, right, then only you are able to bring the network down, which is clearly not feasible, because technologically you can't sort of go and hack 5 million devices at the same time, and definitely not commercially viable. So therefore, hacks, at least in the current way the blockchain is architected, is not possible. With quantum computing coming in, there are chances that things are going to get upgraded, and some of these 51% attacks might be feasible at that point. But at the same time, quantum is several years down the line, and likewise, blockchain obviously is thinking of this issue already, and they are trying to build a newer version of the protocol, which are definitely going to stay ahead of some of the issues which quantum computing might pose in the near future. Now let's look at the actual way the transaction happens on a blockchain and how it is stored. So the entire mechanics of how the transaction is initiated to how it gets stored on the blockchain. So imagine Alice and Bob enter into a transaction. Alice transfers $10 to Bob, and that goes and gets stored in what is called as an unconfirmed transaction pool. So in this unconfirmed transaction pool, we now have 15 different transactions, one of which obviously belongs to Alice and Bob. And as soon as these transactions are there in the unconfirmed transaction pool, a very interesting phenomena happens. So I was telling you, only people who have memberships to the network have the ability to add information to the blockchain network. And so as soon as these transactions are posted, these members are basically rushing against time, competing against each other, trying to do what? Trying to find the next block of this blockchain. And how is the next block sort of found from these transactions? It is basically by picking up the right combination of the transactions, of the 5 transactions. So imagine this is a blockchain which supports a type of block. Each block can have 5 transactions. As I was telling, each block will always have a fixed number of transactions. So in this case, it's 5 transactions. So the network has to now compete and find out those 5 transactions out of these 15 transactions, which are going to comprise the next block. So it has to be time stamped in the same order. And how all of this is done, it's basically done through literally brute force computation, where millions of permutations, combinations are running, and you have to come up with the next version within a 10-minute span, right? And as soon as you are able to hit a specific hash target, and it is matched through the algorithm that you are there, your block gets to the network for their approval. So let's look at some of the mechanics here. So this is basically the block, right? And block has a lot of metadata. In this case, blockchain header or block header. So it will have information on the previous hash, previous block's hash, then the number of other things I was telling about, timestamp and version. Nonce is something which is attached to meet a specific hash target. Again, it's getting a little bit technical here, but just to give you a context. So with all that information, you run a hashing algorithm, and if you are able to achieve a specific target, two things happen. One, obviously a new block is created because the network is going to approve it because it is algorithmically proved to be correct. And two, you get the reward, right? What is the reward here? So the reward in this case is you get 6.25 Bitcoins if this is a Bitcoin network, which means you are getting roughly $75,000 for a 10-minute contribution in terms of computation. Of course, it's not an easy computation. I was saying, it's a brute force computation. It's not even normal machines. These are like application specific ASICs, which cost roughly $15,000, $20,000. So all of that comes together, right? And you get the reward, and you're able to form the next block. And this whole process of picking out those 5 transactions and forming the next block is called as mining. Why is it called mining? Because it's taken from the traditional mining industry where you're mining for rare metals and minerals. And the idea here is that you're mining for precious block of transaction, right? It could be the Bitcoin's next block, right, which is worth $70,000. Therefore, it is precious, and therefore the term mining. And what happens in that is the network approves that I was telling you, and then the transaction is stored in the block. A very interesting thing, which I also want to point out here, is that it is very, very difficult to sort of meet the hashing target, and that is where the entire network is fighting against each other to compete for that $70,000. But at the same time, once that transaction is submitted, it is very, very easy for the network to verify, because these algorithms are very deterministic. You can just run them and always cross check the real answer, right? So it is very easy to verify, and therefore the network is able to verify it in a very short span. And so from this entire exercise, you now have block 358, which has transactions 1 to 5. And this is the existing blockchain from block 0 to block 357, and block 358 goes and gets appended to block 357, right? Now, very interesting thing to note here is that you have information from inception to date. Obviously you see the reference here of previous block. So that previous block information all the way till the genesis block is here, right? So you have inception to date record. Therefore, 358 is connected to 357. Likewise, 357 is connected to 356, and all the way to block 0 or the genesis block, right? So what this does is a couple of very interesting things. One, this has very huge implications for the supply chain industry, and that's where it is being used a lot after the financial industry, right? Is that there's a complete traceability end to end. Nobody can, tamper with things. Nobody can do anything with the information that's stored, and you get complete traceability right from the very beginning. So let me talk about that traceability aspect a little bit here. So imagine there's a malicious actor who wants to alter the state of the block or the blockchain. And so what he says is that, you know what, instead of transaction 3, maybe transaction 13 is the correct version of this block. Fine. So he tries to change that transaction here, and he tries to submit it and get added here. So what he has to do is, as you can see, it's inception to date record. So he has changed block 358. He has to go and change block 357 because it has the block information of the previous block. And once he gets to 357, he has to change 356 and so on, right to the end, right till block 0. So this is now a new state of the block where he has managed to, let's say, change the entire records right from the inception, which I can tell you is extremely difficult, first of all. Secondly, he not only has to do that, he has to then get the network to approve it, because as you know, anything that goes and gets stored on the blockchain has to be verified by the network. So clearly impossible. The network is not going to approve a version of the blockchain which has been completely altered by a single actor, right? And therefore, this immutability aspect comes into play, right? The blockchains are immutable, hack proof. We already saw earlier on how it is hack proof. So coming back to our example of supply chain, because it provides this seamless end-to-end information flow, that is why it is being used increasingly in the supply chain industry after the financial industry. So So now let's look at some of the core features which really help financial industry move to the next level, borrowed from obviously the blockchain ecosystem. So first and foremost is the decentralization aspects. Because it is decentralized, no single authority is controlling it. Therefore, there is a democratization of some of the access issues which we were talking about earlier. Two, it is distributed. Of course, as I was saying, Amazon has distributed sort of data centers. It's not just one, but then in this case, it is truly distributed globally, right? And then it is immutable. Any information which goes on the blockchain is there on the blockchain forever, right? And there is obviously a huge debate going on, especially with the GDPR coming in and right to be forgotten, and a whole host of other issues as to when some information is there on blockchain, how do you forget? Because there's no way to forget. You can only go and add more information, but you cannot undo what has been there. So that is a new sort of emerging area where obviously a lot of work is going on to obfuscate some of the information. A lot of work is going on right in that area. And then finally, a concept called as a smart contract. So it's a very interesting, concept. Honestly, it's a misnomer to call it a smart contract, because these contracts are neither smart and nor are these legally enforceable, right? But as an idea, smart contracts have existed for several decades now. And to put it simply, smart contracts are self-executable programs, small programs that basically mimic real-world contracts. So what is a real-world contract? Uh, Imagine a shipment from Tokyo of salmon to California, right? This shipment has to be at a certain temperature, usually let's say minus 40 degrees or below. And so if at the port in Tokyo, when it was being put in the container, if it was verified and approved to be of good quality, then inside the container where you have all sorts of sensors, temperature sensors, monitors, if that entire information during transit in the ocean is getting transmitted and getting captured on the blockchain, and when it arrives in California, we know by default, by looking at this information on the blockchain, that because the information is on the blockchain, therefore it is immutable. Nobody has tampered with that information. And since you can rely on that information, therefore you don't really need to do a lot of inspection on that consignment. And you can now straight away release the payment. So the payment part gets automated, right? So what a smart contract does basically says if certain conditions are met, you execute the other part, right? So if the storage conditions were met and the fish is in good condition, then straight away release the funds to the bank, right? So that is what a smart contract does. It automates this entire process. And so these four features actually have been helping a lot blockchain in terms of shape the new financial world that we are seeing, especially with some of the technology parameters that we see in the blockchain. So before we get into that, I will walk you through an example of the payments industry, which at least is more familiar, before I get into some of the nuances. So the global payments industry is roughly $110 trillion, obviously one of the largest by far. And within that small segment, which is 1/5 of the size of the total industry, is the cross-border payments. It is $22 trillion. As I said, 1/5, 20% of the total market size. And revenue-wise, this is 50%. So it is highly profitable, right? Yet every year they lose roughly 8% in terms of transaction fees in moving money across borders. A subsegment of cross-border remittance is cross-border payments is the world remittance business. Now, as I was alluding to this earlier on, the remittance business is primarily what friends and family send funds back home for either sustenance, for education, for supporting home loans, and a whole host of other things. Uh, so this business is close to $690 billion, and this also incurred a heavy fees, roughly $52 billion. And if you break that down, cash to cash transfers account for roughly 96%. So it's a huge amount there. And family maintenance comprises 60%, right? So clearly this is for family maintenance sent by, family members working overseas back home. Now, I bring an India example here because India is the highest recipient of the inward remittances. So it has the most efficient inward payment corridors, and therefore some of the best payment providers, some of the best deals that you can get for when you're transferring money to India. And the average remittance to India is roughly about 3.29. Again, this is high compared to some of the other payment methods out there. Uh, Yet, this is definitely very good compared to the industry standard. And if you look at sub-Saharan Africa, this is roughly 9%, right? And most of this, as you saw, is family maintenance, and usual ticket size is $200, $250, right? So imagine $250 and 10% gone, right? $225 meant for supporting a family of 4 or 5 in sub-Saharan Africa. That's a lot of money taken out of the system. From that perspective, this is an area where obviously a lot of work is going on, because people recognize that there are a lot of inefficiencies in the system, and people's hard-earned money is going because of this. Now, let's understand how actually some of these payment systems compare with each other. So bank transfer, again, cost of sending $50 is $5.20. And, post office, Western Union, mobile operator, M-Pesa, this is more prevalent in Africa. Kenya is $1.60. Compare that to a kind of a cryptocurrency, Litecoin. This is only 27 cents, right? So the huge contrast in terms of the funds transfer value here. Now, again, I mean, we're taking a number here, $50. If you change this number, these numbers are going to be different. But just to illustrate the point, definitely cryptocurrency offers the cheapest and by far the fastest way of transferring funds. Now let's see how actually money flows from one side to the other. So imagine, again, let's go back to our Nebraska example. This particular customer walks into the credit union bank here in Nebraska and initiates this payment order, right? So the details on the recipient, the bank account details, the SWIFT code, everything is shared. And what the sender bank is then going to do, they're going to transmit this information, because obviously the sender bank doesn't really have a direct connection to the receiver bank, as I said. So they have to rely on this whole network of intermediaries who are going to help them pass on the message over the SWIFT network, which we spoke about. So what happens here is the sender bank is then going to forward this message to the central counterparty, in this case, the Fed. And the Fed is going to then find somebody in their network called as a sending correspondent bank, or a corresponding bank, which will have a relationship, a corresponding banking relationship with the bank in India, right? So as soon as the Fed is able to locate, this message is transmitted to them, and they transmit the message forward to the recipient correspondent bank, and the correspondent bank on the other side then transmit this information to the central counterparty, in this case, the Reserve Bank of India. And as soon as the Reserve Bank of India gets this information, they pass it on to the bank where the recipient holds the account, and from that main bank, it goes to the specific branch, and that's how the money gets transferred. So this entire process, where you have so many intermediaries, and I've very simplified this process here. So all the intermediaries involved and the time it takes, right? Roughly, it could take anywhere between 3 to 5 days, and it costs whatever it costs we spoke about earlier on, right? So it costs time, it costs money. Contrast that with blockchain, which is basically peer-to-peer. All you have to do is use a mobile app on one end and the other end, and you can make this transfer instantly. I'm saying instantly, okay, I mean, if you are on the Bitcoin network, this might take 10 minutes, but if you are on some of the other networks such as Ethereum, etc., then this is going to take just 10 to 15 seconds to get approved and get transferred, right? So it removes all the intermediaries, cuts all the cost that's involved in the traditional finance space, and does transfers directly. So it saves time, it saves cost. Now let's look at the financial sector per se, and how it is structured, and what are some of the innovations that are going on. So before we get into that, as I was saying, let's look at the current system per se. So the banking and the financial institutions today have unprecedented access to the data on us, right? We give them all sorts of information because that's how they have to do the KYC, store all that information and use it. To the extent that this information becomes proprietary knowledge for them, basis which they can clearly underwrite loans and other things to us, right? So they have a lot of information on us. To sovereign insurance on the deposit that happen in the banks, right? Whether it's FDIC or some of the other things, you can just sort of understand the ecosystem, how, on a sovereign you can get a sovereign insurance on all sorts of deposits to a bank. And of course, they have a very special status as a supplier of credit, right? So that's another area where they have major access. And finally, because these banks have been there for such a long time, therefore they have a distributed network spread globally in case of big brands. And if there's a smaller branch, still they have a huge network, right? So any new player who has to enter the financial industry, there are major issues, right? Because you're dealing with more or less a very monopolistic system where barrier to entry is very high. You have huge capital requirements, first of all, to enter. And then, of course, huge regulatory and compliance barriers to overcome before you can think of setting up a new financial institution. And that more or less sort of explains why there is no incentive within the financial institution in the current way that it exists to innovate, right? Because the barrier to entry is very high, it is very monopolistic, so why innovate, right? Consumers don't have a lot of choices. And that is where, to some extent, fintech industry in the last 15 years, I would say, has been trying to do their bit. Of course, they have been, successful in certain pockets, and then there's another work to be done in major areas. So places where fintech has been successful, I would say, is largely in the retail space. And there are multiple use cases, starting with peer-to-peer lending, of course, Lending Club we all know about, and their competitors. So that's a big area where they've been very successful. And then crowdfunding of various projects, crowdfunding of a lot of things are getting executed through fintech platforms. Cross-border payments, of course, as I was pointing out earlier, is a major pain point, which some of these founders actually bore themselves when they were either students or, getting money from their parents, or they had young families. And that's how they came about this idea of solving this problem. So you find a lot of fintech players in the cross-border payments space. And then a very interesting area of underserved markets. So what are these underserved markets? These are primarily small businesses, SMEs, which again don't fit into these, the framework of the financial institution in terms of getting them as their valued customer. So these people have money, they do business, but they don't fit into the specific mold. Therefore, they don't get access to the financial industry, and that's where fintech comes in, offers them the services by packaging them differently and coming up with innovative business models. Now, despite all of that, fintech hasn't yet disrupted the finance industry, right? I would say it's basically done to the contrary. It's not really, helped from that perspective. So what is the primary reason? The primary reason is that fintechs, obviously, as any startup would struggle, right, to get early users and adopters. And for a startup with not a very significant name in the market, that's a very, very steep ask to get, solid user base. And that's where they are reliant on banks for partnerships, right? And this partnerships helps them give access to the banks and users. And for the bank, it's a win-win, right? The banks now have access to technology, which is going to set themselves apart from some of their competitors. And the fintechs get access to the user base. So it's a good partnership, very symbiotic. Two, it reduces the regulatory compliance for the fintech. And why it does so is because now all the onus is on the bank, not on the fintech startup. Otherwise, the burden of finance, even though the way it is set up today with all the sandboxes globally, the fintech industry gets a very lenient treatment in terms of applying some of these regulatory frameworks. So the exorbitant cost is not always borne by the fintech, but coming under the banking umbrella, it just takes care of all the financial regulatory issues. But what happens in the end is these fintech industry players end up just building already a faulty system, or a system which had a lot of friction, which was inefficient, right? So it's more of a patchwork trying to make do. And so we don't see the first principles approach in terms of building it. The same first principles approach which we probably saw when the streaming companies came in and they disrupted the model fundamentally, or how Amazon came about and changed the retail commerce space, or even ride sharing in the transportation industry. So those kind of thought process I definitely don't see in the fintech space. It's more of partnering, and in the end getting acquired by some of the major banks. So that's basically the exit strategy, more or less. Now, when we look at the blockchain space and why blockchain is not going down the same route as the fintech space is primarily because of the fundamental underlying infrastructure. So the fintech players are reliant on the banking industry because they have to use same kind of user base. They are using similar technology. Therefore, they have to ride on a bigger player in the technology space, which in this case is financial institutions and the banks. And therefore, that partnership makes sense. With blockchain, which is basically a distributed network, the industry is basically building a fresh infrastructure ground up. Therefore, there is no way they can rely on the existing banking infrastructure. Therefore, it is a complete fresh, first principles approach. And importantly, there is a direct competition between the blockchain-based services to the banking services, financial institution services as we know them today. So that's one part. Two, because of all the things we've been speaking about, the smart contract, the decentralization, no single point of failure, unparalleled security, immutability, all the good things we've been talking about, what blockchain lends, right? That actually helps lower the counterparty risk systematically within the blockchain-based network. So now you don't have to rely on a trusted intermediary or a network of intermediary to get in that trust. The system itself provides that trust. The software is built in a way that you have that trust built in, right? So you don't have to trust on anybody else, but on the software. And riding on top of all of this that's happening in the blockchain space, in the finance space, is a new revolution, which has been termed as decentralized finance in the blockchain space, or DeFi for short. And what is DeFi, or decentralized finance? So it's basically financial institutions services built on top of decentralized blockchain networks. So what financial institution services do financial institutions provide? Things such as opening of bank accounts, saving accounts, loan, mortgages, insurance, derivatives. So all that you can think of in the traditional finance industry also is getting built on the decentralized blockchain infrastructure. And what this does is fundamentally one very important thing. It gives universal access to people because now you are not reliant on the bank's complex procedures, bureaucracy, time, access issues, right? You can directly create these or take part in these financial products which are out there built on the decentralized network. And what you need, all you need is basically an internet enabled smartphone, right? And on that smartphone, you log in to this particular application or decentralized application or a decentralized finance application, download it. Your wallets are attached to that and you start transacting straight away. You don't need any sort of approval or any sort of time delays. So because it is decentralized, therefore there is no central control. That's very obvious. What's not so obvious is most of these decentralized applications that are getting built, and again, this is very early days, if I can put it that way, for the industry, because industry is just 5 years old. is that these decentralized applications, which are not centralized, are not truly decentralized also. So there are aspects where there is some amount of control with the core team. So in case of something going wrong with the platform, they have the ability to switch off, in the sense that withdrawals can be stopped, or if a hacker is trying to gain access, it all can be controlled. And once the problem is settled, then the switch is turned off or turn on again, right? So that kind of control is there with some of the projects. And again, it is based on agreed community voting mechanism. So community decides and then votes, yes, this is the right way of governing or controlling funds. And then over time, that 30%, 20% control comes down significantly once the protocol is mature enough, where hacks and security issues have been addressed. So it is not purely decentralized also, but it has the ability to be truly decentralized, but then it might be very chaotic at this stage, because governance in decentralization is something which is being worked upon. Therefore this 80-20 sort of arrangement is much better. uh, Again, think of any global institution, right, which is there today, like Standard Chartered, Citibank, whatever, right? It's taken 50 years or so, right, to get to that point, right, where the truly global banks, right? Any new financial institution which has to come up today has to go through so many local regulatory compliances before they can actually start doing business. Forget about global. Global is definitely 10 years down the line, right? Uh, Contrast that with decentralized finance. This happens automatically on day one. So day one, you're a global business, and everybody actually can take part in your product. And finally, it is permissionless to create and permissionless to participate. What does that mean? So permissionless to create is, you can create your own financial products, right? Because you have the underlying blockchain infrastructure layer, and all you have to do is add layers on top of it, right? And you are able to build it. It's pretty much like a plug and play. So think of it as Lego's building blocks, right? You could have, insurance on derivatives, right? So you have the derivatives asset as an underlying asset, and on top of that, you can build a layer where you are able to insure the underlying asset, which is the derivatives. And these are all crypto or digital assets, right? So that kind of newer offerings are possible in this, because you don't really need permission. You don't really need all that authentication, which usually comes with the traditional systems. Now, let's also look at the value of this market. So the value in this market is measured by a term called total value locked, right? And so the total value locked in decentralized finance space in Jan of this year was 650 million. And by the end of September, this is $9 billion, right? And if I look at the figures today morning, this is $11.21 billion. So what we're looking at is, in a span of 9 months, there is a multiplier effect of almost 17 times, right? And number of things have actually helped. One is obviously the COVID has been extremely good for the business, because people started to look at various options of sending money overseas, or just basically making digital payments. And that is where a lot of new first time users came in. And when the users came in, they realized the potential, and they started with some of the aspects of lending. So lending has been very, very good for some of the newer crypto converts. And all of that has basically contributed to the surge in this. But this is a market which is extremely positive, growing at a rapid pace, and newer models are coming in, and I'm going to talk about that shortly. So things like automated loan. And what is automated loan? Imagine two people sitting in two different parts of the world, right? Again, let's go back to Nebraska and Delhi. If people have to negotiate a loan between them, those two people, Nebraska and Delhi, today that is possible using some of the applications out there, where the system is going to negotiate on the two parties' behalf. Then the amount is going to be logged into a smart contract. It is something like an escrow. And once the deal terms are finalized and executed on the blockchain and they're stored there, then this transfer happens, right? So this thing is not a futuristic tale. This actually is happening as we speak. Now, let's look at the decentralized finance space and what are the major use cases. The first is, of course, lending. I was talking about lending. So, lending, what happens is you put in your crypto asset, could be Bitcoin. And why Bitcoin? I mean, there are other crypto assets as well. For people, Bitcoin appreciates a lot in value. It's more or less something like a precious commodity. And so people don't want to sell it. So what happens is people would get their crypto asset locked into a smart contract, something like an escrow, as I was telling you, for a period of time, maybe 90 days, and that amount actually earns interest because it can be used in multiple other things such as yield farming and whatnot. So there are multiple concepts out there, and so this person after 90 days has to return the principal and the interest part, right? And then unlock the Bitcoin back to his wallet. So that is basically the lending space. Then decentralized exchanges. So what is a decentralized exchange? So this is pretty much like a exchange which we all know of. The London Stock Exchange, the New York Stock Exchanges, basically trading in various stocks. So here people are trading in various crypto stocks, right? So companies issue their tokens and people are transacting in them. The difference here is that this crypto trading happens over the decentralized blockchain network. So these exchanges are built on top of decentralized blockchain network. So it is more peer-to-peer. Nobody controls it. There is no central authority. There are no clearing houses. None of that. So that's another area which is obviously very big in the DeFi space. And finally, asset tokenization. Again, there are multiple ways in which this asset tokenization takes shape, but I'm going to talk about just one here. So imagine there is a real estate somewhere downtown Manhattan, maybe a studio apartment or two-bedroom flat worth $10 million. And I here sitting in Delhi want to buy that property. So one, of course, I have to go through the hoops of legal, regulatory, compliance issues. But importantly, I need to have that entire $10 million in my account to be able to buy that property. Of course, discounting so the mortgage and other options. So if that has to happen, I need to have $10 million. Otherwise, I'm not going to get the property. So it's pretty, yes or no kind of a situation, right? Now, what people are trying to do is they are fractionalizing this. So what I mean by fractionalizing is they're putting this asset onto a blockchain, converting that, using that as a backup, and creating tokens on top of it, right? So $10 million worth of crypto tokens, and broken down into 500 or 500 $100,000 values. So now I can actually buy $10,000 worth of this apartment or studio apartment or whatever that is. And likewise, I can do other parts of the world. I could do that in Tokyo, I can do that in Shanghai, I can do that in Delhi. And so now my global portfolio of real estate is ready. And as the value of this asset goes up and down, I can transact and sell this in the secondary market where my tokens are going to be sold or traded in. So that's a big part which is happening. So those are the three key areas. Then other than that, payments we spoke about. Payments is a very big area in this space. Derivatives market is again very, very important. And margin trading. Margin trading obviously, helps a lot in terms of, traders who are very, very active in less low cap projects. So in conclusion, the blockchain is definitely disrupting the finance industry in a number of ways. Obviously, as I was saying, it offers some of the advanced features which the traditional finance is not able to offer, because of course the way it is structured, it has a lot of onus on itself to provide safety, security, consumer protection, and a whole host of other things, because of which they are not positioned to serve some of the markets. So the two problems, one is the access issue and the other is the selection of the users. Those two problems remain with the finance industry, and that is where blockchain comes and addresses those two problems, and it has continued to gain inroads. So just to get to that specific point, let's take two major corporations today. JP Morgan. So JP Morgan is deciding to come up with a coin called JPM coin, which will be their cryptocurrency for their users to transact in, and eventually they'll be opening it up to the rest part of the world. So the point I'm making about JPM is that it's not just JPM. If I look at any major, if I look at the list of all the major financial institutions globally, I think none of them would not be experimenting or using blockchain in some form or fashion. So either some heavy duty POC work has been going on, which they are now trying to implement, or they are looking at some full-fledged implementation because they've gone past the POC stage. So banking and financial industry per se is well aware of the challenges that are posed by blockchain to them, and they are trying to experiment and do things with them. But the problem with that is it is again at the peripheral level. So they're trying to do things to protect their existing business, whereas as you saw, it's a very different ecosystem which is getting built up, and if they have to adopt that, it more or less goes against their established core business model. So it's going to be very interesting to see, excuse me, to see how these two competing forces come together. One is experimenting with this emerging technology, and then protecting the existing business, which is built on the traditional sort of infrastructure. Likewise, Libra coin, which is owned by the Libra Foundation, which is obviously headed by Facebook. Facebook created that foundation, and it has 30 different members, including Facebook, including MasterCard, Visa, PayPal. So the big names. Of course, some of them left also after the government, the Senate called into the question some of the aspects of the coin. But Mark Zuckerberg is truly committed to bring this Libra coin to all its Facebook users in the next 2 years' time, right? So he's working, hard on that, along with these 30 members drawn from different business ecosystems. And imagine in 2 years' time, if half of humanity has access to crypto coin through Facebook, right? That's going to be huge in terms of user adoption and actually democratizing access to financial services, which is not there today, even in some of the leading economies. And then you have this YouTube effect. So what YouTube did back in the day was help sort of democratize the creation of video content and the distribution of video content. So anybody could create their video and distribute it. Similar things are happening in the blockchain space, especially in the finance ecosystem, where people are able to build their own financial products without the involvement of any central controlling authority, right? So we spoke about this example of insurance on top of derivatives. That is something which is definitely feasible and possible, and it would not be surprising if somebody comes up with that idea. I've not seen that idea, but if somebody comes up with that idea, this is something which is going to be lapped up by the market very quickly. So what this does is it gives them the ability to create their own tools based on the needs of the market. And some of the markets which are not market needs which are not addressed by the existing players are actually getting addressed. And how? Because there is a market for products which are never envisioned. So things like multi-level marketing or matrix marketing, where you have 30% referral, 20% referral bonus, you have upline, downlines, right? All of this happens in the regular market space, where of course the financial institution can't get involved because of the risk associated with it. Now with blockchain and decentralization, these things are happening in a truly decentralized, automated manner, where peer-to-peer, this sort of smart contract is formed, and people are getting money based on the commission, and they are getting that paid because that money is getting invested into yield farming and some of the other areas. And of course, the money is appreciating in value as well. So people are able to earn handsome returns of 8, 9, 10%. I'm again, don't take me as a advice on this or invest. Definitely do your own due diligence. But what I've seen is that the market has been exploding. Maybe it's the early stages of this market going up, which is causing this momentum, but there's been a huge surge in the value. So multi-level marketing is one. Then there's another concept where imagine 10 people come together, each contribute $10,000 to a pot of money, and that money is again used for yield farming or some of the other areas where it earns interest in that 1 month span. At the end of the month, the smart contract runs, and through logic, it selects one person, and that person gets their $10,000 back along with the interest that this 100,000 earned. So they got the interest plus the $10,000. Rest everybody got their $10,000 back. So what this means is people get risk-free interest earning. Otherwise, they at least get the capital back. So these kind of newer models which are there, possible because of blockchain, clearly wouldn't be possible in the traditional space. And here the value is created by the participants, right? Both the lender and borrower, they are creating value, and the value is getting shared. Unlike the traditional finance, where all the value is captured by these institutions on the money of people, right? So people's money is given to them, they use that money, capture all the value, right? Here in this case, that value is distributed, through the smart contract fairly. All these percentages are decided before entering into the contract, and who's going to get what. Everything is basically decided peer to peer in this case. So what we do as a company, these are the things we do. Obviously, we do blockchain consulting, we do developments, all sorts of developments. We talked about smart contract exchanges. So end-to-end solution in the blockchain space, right? From the idea, inception to execution, deployment, launch, and the rest of it, right? The maintenance part. And obviously, we talked about the exchange, the barter trade, which is a centralized exchange based out of the 4 continents we talked about. So that is a very novel exchange. You think of it as the version of Binance, Coinbase, and playing in a very niche segment. So if anybody has any interest, happy to talk about that as well. And these are my contact information, my email, LinkedIn, anything else here. So I think with that, I will let me end this presentation and take some questions. I hope you